Let's talk Treasuries. They're down again today, pushing 10-year yields towards their longest stretch of weekly increases in 19 months. Ira Jersey is the director of U.S. rate strategy at Credit Suisse Securities. It's one of the 18 primary dealers that trade directly with the Fed, and he's here with us in the studio today, making us a little Christmas Eve visit, if you will. Ira, thanks for coming in.
Yeah, lovely to be here.
You know, your most recent note was interesting because you said the rates market is deeply oversold.
Yeah, well, one of the big reasons why we believe that is because because inflation is not likely to pick up. We still have a lot of slack in in the economy. There's not a lot of reason to think that the output gap, so the amount of potential GDP and current GDP, is going to close anytime soon. It's going to close, but it will take a number of years, and that means that the Federal Reserve is likely to be on hold for longer than the market's currently expecting, and that will require lower rates to stay longer. And I think one of the other things that's happened with some of the stronger data, there's been some question as to whether or not the Federal Reserve will keep the asset purchase program that it started a couple of months ago in place beyond the June 30th deadline. We think that they actually will. Our house view is that there's not a lot of reason to do QE2 when there's not going to be a QE3.
Let me back up a little bit to the levels where we are now in the Treasury market and the recent move that we've seen, because I think people were expecting this move, just not when it's happened and as dramatically as it's happened. You know, traditionally the stock market has discounted things pretty far in advance. The Treasury market hasn't necessarily done that to quite the same degree. Do you think it's just a change of mindset? You also have a lot of folks who were traditionally equity, perhaps, who might have been getting more involved in the Treasury market.
I think there's a couple of things that have gone on, and one of the big things is that a lot of retail investors had gotten into Treasuries kind of chasing returns because fixed income markets did exceptionally well in 2008, 2009, and the first half of 2010. But then when you look and you see a two-handle yield for 10 years, you say, well, wait, do I really want 2.5% for 10 years if you're a retail investor? So one of the things that's happened, and we talked about this over our Bloomberg messages yesterday, was that the ICI data came out yesterday, and you've seen actually retail investors pulling out of Treasury and fixed income mutual funds.
Right, they've started to do so.
And that's important because they've put in hundreds of billions of dollars into these funds, and if they're pulling away at the same time there's not a lot of liquidity in the market, that's really caused a big backup. It's kind of interesting because what happened in the most recent sell-off is we kind of had a year-end sell-off in November, and then not a lot of risk-taking. I mean, there's a couple of different technical reasons for that. One is that most of the major primary dealers now have fiscal year ends that end December 30th, whereas we used to have a few that, like some of the broker dealers, for example, that used to have November 30th year ends. And when they had November year ends, they were able to step in, provide liquidity for December when the banks that had primary dealerships were basically not taking risk.
Right, but
you don't have that anymore. So no one takes risk in December, and you sell what you did well in, and up until the beginning of December, end of November, beginning of December, Treasuries have done very well. So
to get back to the idea of the retail investors and the bond outflows that we have seen, in fact, the biggest withdrawals from bond funds in 2 years, according to the data that you mentioned. Even if the fundamentals don't support inflation going up as quickly as the bond market seems to be suggesting, if the retail sentiment has turned against bonds and you continue to see these outflows, I mean, why couldn't we continue to see the yields push up?
Well, I think there's two things. I think one, there is a demographic shift going on in this country. So at some point, and somewhere around 3.5% might be a decent number for that retail flows will wind up stabilizing, and you wind up having closer to zero as far as net flows go. And so then it becomes, okay, what are the economic fundamentals? Where's inflation going? How fast is growth going to pick up? How bad is unemployment going to remain? And as we focus on those fundamentals, that's where we think that the market's going to rally. Are we going to see 2%? Unlikely. Are we going to see on 10s rally back to 3%? We think that that's a decent target for the medium term at this point.
Let's talk about some of the different indicators you're looking at when you look at whether the bond market could be swinging back towards those kinds of levels, because I know you're looking at some different charts. Which one do you want to look at first?
Well, it would be great if we could look at our mutual fund duration bias chart, because what we do is we take basically a whole number of bond mutual funds and we compare it to a major benchmark index, and then we say, okay, are these mutual fund managers long or short treasuries on a daily basis? And what we saw basically back in October was, prior to quantitative easing and the Federal Reserve buying a lot of treasuries, was managers got very long, and they subsequently in November got got short again, and now they're getting closer to neutral, but they're still short, and we think that that's actually a positive sign for the market over the very short term. And reason being that mutual fund managers have not been the most optimistic on whether or not rates were going to go up or not. So when we were down at 2.5%, a lot of mutual fund managers were short the market, and so they had a pretty good run.
So now maybe they're getting back
QE2.
in.
Yeah,
okay,
that's right.
Gotcha. I know something else you're also looking at is well, you're looking at a couple different things. You're looking at the break-even in the 10-year, and this is essentially where traders think inflation is going to go. It's the difference between the 10-year and the TIPS, the Treasury Inflation Protected Securities.
Correct. So it's basically the market's expectation of what average inflation is going to be over some period of time. And in the case of the 10-year TIP, that actually has gone up a fair amount. So inflation expectations are actually rising. And if you actually look at what 10-year break-evens have done, we basically earlier this year hit a low, and we've subsequently gone up. So in a way, you can say, okay, well, the economy's going up. Everyone thinks that there's going to be higher inflation. So it's reasonable to expect treasuries to sell off when the market and others are thinking we have decent expectation. But then you look at things like the University of Michigan Consumer Sentiment Survey today, and basically every retail individuals think that there's not a lot of inflation in the system. They're expecting 3% inflation and 2.8% inflation or so over the next 5 years. That's still not very high, and that's basically where they've been for the last 2 years. So there's not a lot of reason to think that inflation is going to jump higher. But at the same time, it's definitely moving in that direction with more optimism on growth.
Oh, what about, sort of some of the anecdotal indications we might be seeing on inflation? I'm reminded of a recent story that Walmart is letting the rollbacks on toy prices expire and is going to let those toy prices rise. And, we all know that food prices are increasing, but that's not something that the Fed takes into account, and, because that's not in the core. But toy prices, that's not something you eat.
That's true.
Well, a lot of kids eat their toys.
But it is actually discretionary income, right? So the thing is, the question is, are there going to be incremental cutbacks on prices of things that go up? So on discretionary items, non-discretionary items, things like gas, things like food, things like you'd think refrigerators and the like. Interestingly, people aren't buying some of the bigger ticket items, and the reason that they're not is because there's not a lot of household formation. So the question is, if toy prices go up but volumes wind up going down, is that necessarily a good thing for corporate profits? Corporate profits are still very strong. We actually think that corporate profits will do reasonably well next year. We do expect the economy to grow. The question is, how many speed bumps are there going to be, and will inflation actually pick up with the slack we're seeing in the system? So
in other words, if you take the toy prices example, you're saying we could see some pushback from consumers.
Sure.
They might not be buying as many toys, and therefore,
how many Bloomberg stories have there been on top Bloomberg stories, whether that you've reported or have been on the terminal, that have said corporations have good sales but on discounts.
Right.
And so the question is, where's the supply-demand imbalance going to be? So are margins going to improve because you've now increased your prices, but at the same time your volumes are going to go down. So that means that your unit sales might not be as good. Which quite frankly, depending on where inventories are, it might not be a bad thing. I mean, if inventories are very lean, then clearly that's not a bad sign. So you might get back to a more traditional economic scenario than that you had, say, 30 years ago, than what you've really had the last 20 or 30 years, where everything's been financed by debt and factoring, and now you're just saying, okay, well, what's our inventory, what's our working capital, how much cash do we have, not how much cash can we borrow in order to buy our inventories and everything else.
Ira, we just have a little bit of time left, about 30 seconds. I just want to bring up the auctions next week. Sure. I know you're not going to be around to see them, but we do have a lot coming to market next week, starting with $35 billion in 2-year notes early in the week. You have that on one side, you have the Fed buying on the other side. How does the supply-demand equation look going into next year?
Well, it's interesting. The issue you mentioned before about whether or not the bond market was forward-looking, and I think one of the things is that it is forward-looking insofar as things like 5- and 10-year treasuries are looking at whether or not the Fed's going to continue to buy beyond June 30th. 30th. So on days, it's interesting because on days that that the Fed is buying and there's not auctions, the Treasury market's done better than on days when there has been a lot of supply. One of the things that kind of really hurt the market in a big way was the tax compromise, because there's less revenues for the government. People are a little bit more concerned about the fiscal situation, and all year the Treasury had actually been cutting the sizes of its front-end auctions that are occurring next week, and now they're not going to. It's very clear that they're going to continue on this path of very large auction sizes.
Okay, Ira, thank you so much for coming in, and got to meet Ira's boys and his mom today, tagging along ahead of Christmas. Thanks. Good to see you. Ira Jersey of Credit Suisse.